Hey everyone, my name's Andy. My channel's Finding Value. This presentation, I'm going to go over what's called ratio bets, and it's really understanding what the bet you're making is. I don't think a lot of the people who are leaving comments necessarily understand what the bet is. So I want to go over this and make sure everyone understands it, because everyone wants to leverage up so much on some of the things that we see in the ratios. For example, if I see platinum and we have platinum at a very cheap ratio, my recommendation would be buy physical platinum. It is the lowest risk, most direct way to play it. Everyone wants to buy companies that leverage that bet. So I'm going to go over some of the things of why you might not want to be leveraging your bet with companies. And also, just how much leverage do you need? So that's what I'm going to talk about in this clip. We'll jump in here. I call it ratio bets. So my opinion is you can de-risk your bets if you understand the ratios and how much leverage you already have. Everyone wants to leverage up my knowledge of ratios with companies. And I want you to keep in mind, I am using physical precious metals for the majority of my money. I use a lot of royalty companies behind my physical bets as my other larger holdings. And then I use smaller portion on companies which really leverage my bets. And the question you should be asking is, why am I doing this? What's the reasoning why I have such a large physical precious metals holdings? Why, right? So what I think is different between some of you and me is I understand the ratio bet. I know this inside and out. So if you think about it, I'm already massively leveraged with my physical precious metals bet. And I know and understand the bet. I think what a lot of other people are doing is you are most likely pricing the bet in dollars. I'm not. And if you're doing that, I think you need to better understand the bet and use the ratio. I know that might be confusing. I'm going to go over a couple of examples here. Value is the key driver here, and it is relative. It's relative. It's not to dollars. It's relative to other assets. So what do I mean by all of this? And I'm going to go through a couple of examples to show you what the ratio bet really is. So I've got my thinking on the left-hand side, and I think what most people are thinking are on the right-hand side. So I'm betting on gold increasing in value against the Dow, against stocks. I am looking for purchasing power gains. I understand assets get repriced in different market conditions. Now on the right-hand side, what I think most people are thinking, others are measuring their bets in dollars. They're looking for dollar gains. They don't understand that assets get priced differently in certain market conditions. That's the disconnect between me and I think a lot of people in this world. I am looking for purchasing power gains. I am looking for assets moving against each other. I'm not pricing my bets in dollars. I don't care about the dollar value. I want to buy more of if I'm owning X, I want X to buy more of Y. If you're looking at dollar gains, I think you're not doing it correctly. And you have to understand that these things are going to get priced differently. You can't look at today's paradigm and value Tesla and think that's going to continue 5 years from now. And the reason I say that is if interest rates go higher, all of these technology companies, all of these stocks are going to get repriced completely different than what they are today. And that's what everyone is missing. Now, if they're successful at holding these things up and propping up stocks and some of these technology companies, what that means is that they're going to hold interest rates very low and you're going to have very large negative rates. They're just going to get repriced differently, but the dollar of those items are going to remain flat. They're not going to really go up much. But everything else that we are in is going to get repriced way higher in relationship to those other assets. So here's a paradigm difference. Okay, it's me on the left, and I think everyone else on the right. They're going to say gold goes to 10,000. I'm starting on the right-hand side here. $10,000 an ounce. They see a 5 times gain. And they'll say, well, I want to leverage up on that. They're not happy with the 5 times gain. And I want to push more leverage. So they pile into producer explorers with all their money. I'm on the left-hand side. Gold goes to 10,000 ounce, but at the same time, the Dow goes down 50%. The same time we go to 10,000. I see a 10x gain in relationship to the Dow in my eyes. They see a 5, I see a 10. And the way that I'm going to push the leverage is I use different physical precious metals to push my gains and leverage, which would be silver and platinum. That's how I'm pushing my leverage. But I'm doing it with so much less risk than going into a producer or explorer that they're not equal bets. I'm going to beat you every time because the risk isn't there. So I'm going to talk about the different metals. So let's say silver's ratio compresses to 30 against gold from 90. It was 120 at one point, but I don't think you could have ever got the physical for 120. But let's just use 90. Your return is 30 times the Dow. And this is using the physical precious metals. And that's if the Dow goes down 50%. On the right-hand side, platinum compresses against gold from 2 to 0.8, which I think it could probably go to a half or even a quarter, or even a 1. It could go to 0.1 at some point. But I just use 0.8. Your return is 25 times the relationship to the Dow. And I think both of these metals, the potential returns could be even greater for them. Maybe it's 60x, maybe it's 50x, I don't know. But what I'm telling you is it's probably at least 30 and 25. Is that not enough leverage in relationship to purchasing power to stocks? I think it's plenty of leverage. And you're doing it using physical precious metals, which is basically the lowest risk that you can potentially have in the world of anything. They've never gone to zero. They don't have any business risk. There's no counterparty risk. There is nothing there. They protect you against a dollar decline, etc., etc., etc. So my question is, how much leverage is needed in these bets? I don't think you need to push the leverage very much to get the returns people expect. And keep this in mind, at the end of bull markets, gold and silver mining companies, the last bull market, they underperformed the price of gold itself. They did not match the price of gold the second half of that bull market. They did very well from 2000 to 2004. Then from 2004 to 2011, they didn't do very well. They underperformed gold. Not all of them, but a lot of them. If I know that the ratio is cheap and that we are in a market conditions that will move the metal higher, why would you not take the least risk bet? If you know the value is going to get repriced with time, and this is as sure of a bet that we can have for a revaluation, you take the bet. You don't try to leverage up on something that may not ever materialize in the market. You're taking far too much risk when you could just take the bet with the physical and be done with it, and already have a 30x leverage to other assets, like the Dow. And in mining companies, you need the bulk of your money in bets that will for surely move with the price of the commodity. If you know an opportunity is here and you take your bets, and those bets do not perform the way you want them to in relationship to the commodity, then you just blew your huge opportunity. And I'll tell you, there's a lot of companies that do not outperform the metals. So you have to be extremely selective with what you are choosing and the risk that you're taking. If you go into if you look at ConocoPhillips, the last bull market, I don't think they outperformed oil. You would have been better off buying oil itself than some of these large major oil companies. Because oil went from 10 to 140, that's a 14x increase. They didn't go up 14x. And I'll be honest, some of this happened to me last bull market. I was invested in some companies that did not perform like I thought they would have performed. That's why I'm piling into what I think is the most for sure bets. Physical metals by far are the least risk, most direct way to play the move. So, conclusion here. Sometimes mining companies underperform the metals, and this often happens at the end of the bull markets. And it could happen for 5 years or however many years at the end. It could be a substantial amount. I like physical metals, and they provide all the leverage needed to win big. You don't have to leverage up with all these companies and producers and mining companies. Leverage is fine to use, just be strategic with your bets and don't use the majority of your wealth in that area. I don't think it's wise. And they say, a lot of people say, the younger you are, the more risky you can be. I'm going to tell you that that's flat out wrong. I'm going to try to change your paradigm and think of it this way. The younger you are and the lower risk bets that you are more certain of winning is a better strategy over time. And the reason I say that is you can leverage your lower risk bets more over. You can cycle them more and more and more over time with larger sums of money and get far better returns. If you are struggling to figure out what I'm talking about, I have a whole bunch of examples of how you can turn $10,000 over like a 10-year period into millions of dollars, taking just precious metals and swapping precious metals using ratios. I have videos all about how to do that. Some of them returned, 14,000 into, I can't remember however many million, using rhodium and palladium and platinum. Those are extremely low risk bets. Extremely low. You're buying under the mining costs of the mining of that. And then you know that there's massive deficits out in the future for some of the metals. Platinum's that way and silver's that way right now. Why am I loaded up in physical precious metals? And why are a lot of the people asking me about how to leverage this to the max? I don't know if that's the right way to play it. The physical precious metals, I think, is the lowest risk, highest leverage, easiest rewarding spot to be. That's my opinion. That's what I've experienced over these bull markets. And if everyone wants to just dump all their money into mining companies, I just don't think it's going to work that way. I don't think some of them might work out very well, but there might be a lot that don't work out for you. It's not as sure of a bet. And if you know the ratios are cheap, if you know they're going to move, if you have very good certainty with that, you got to put the bulk of your money in the lowest risk bets that you know have pretty good leverage. Because if they have a 20x leverage against another asset, that is very good. You don't need to go to a 50 or 100. Because what if they don't pan out? But you know for sure, it's not a for sure 100% bet. Nothing's 100% in the world. But if you're going with the least risk, this stuff is least risk. It has less risk than dollars. If you've noticed, the dollar's been declining quite rapidly. It's been going down, 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 down. Gold and silver are going to account for this. They're going to go higher, but again, they're not 100% linked. They're going to go higher. It's going to move higher. Now, when this stuff moves higher, the ratios are all going to compress and expand. And whenever you buy in an undervalued condition, the conditions will change, the market conditions, and they're going to get revalued differently in the future. That's my opinion. So what I want everyone to think about in their portfolio is, why are you leveraging up with so many mining companies? Is that the right thing to do? How much physical precious metals do you have? Maybe there's an opportunity to de-risk your portfolio. That is my viewpoint. if you can get 20x times, if you're in very rare opportunity where gold and silver and platinum are very cheap, and they're also used as insurance, they're also used as some of the least risky things in the world. They're less risk than cash. I mean, think about that. You can get a 20x taking less risk than cash. Why not take that bet? Why not take it with the majority of your money? That's as good as you can get for a bet. But no, let's leverage up with human beings involved, with a whole bunch of other, what we'll call it, risks associated with companies. Taxes, you've got nationalization risks. There's so many things. There's like 100 or 200 things that you could probably list very quickly off the top of my head. So think about it. Think about how much risk you're taking, and think about, look at some of my videos on ratio bets. They are extremely simple, extremely easy to understand, I think, and they can generate a whole bunch of wealth without taking the risk. I've made a lot of money doing it that way. Now, I've made a lot of money in some of these companies too, but I think you got to think about how much risk you're taking for that amount return. And if you don't have to take the risk, why take it? If you appreciate this video, click the thumbs up, subscribe if you're new, and thanks for listening. This is Finding Value.